The taxable brokerage account is the ultimate investment account for your early retirement. But the investment account itself is just a tool, and it's useless if you don't know how to effectively use it. So today you're going to learn why this account may be the ultimate account for your financial freedom goals, and then I'll walk you through 4 different great strategies to think about so that you don't miss out on all the advantages this account has to offer. Once again, this is Matt. I'm a certified financial planner and advisor over at 1 Degree Advisors out here in sunny San Diego. And on this channel, I make videos to help you retire early with confidence. Okay, so for the clients that we work with that have retired early, I've really found this account to be pretty much one of the best accounts, especially for those of you that are in the camp of maybe wanting to retire at least around age 50 or 55, or at least if you want to be in a position to have work optional at that point. But let me explain why I think this is the ultimate account. So when it comes to saving, at least here in the US, you have a ton of options. You've got Roth IRAs, traditional IRAs, 401ks, 403bs, just to name a few here. And they are all very powerful retirement vehicles. There's just one problem. Virtually all of the traditional retirement accounts have very strict rules when it comes to managing them. For example, they have contribution limits. If you make over a certain threshold, for some accounts like a Roth IRA, you can't even contribute at all. Your 401ks and your 403bs are also limited in what you can contribute, and most folks have very limited investment options in their employer accounts. This isn't to say avoid investing in a 401k. My point is that there are limits and trade-offs that can make a difference in the way you plan and save, especially if your goal is to retire early. And lastly, for those accounts, and perhaps one of the biggest factors that a lot of you may know, is that you'll be subject to an early withdrawal penalty of 10% if you take withdrawals before age 59 and a half. Again, this isn't to trash retirement accounts, it's that they have limits, and I want you to know all the trade-offs. So what do we do about this? Well, in comes the taxable brokerage account. Why? Well, because there, number one, are no income limits, no contribution limits, no penalties on withdrawals, and there are also preferential tax treatment, which we're going to talk about how someone can literally have a $0 tax bill in retirement if they properly structure this account. And ultimately, I believe this account has some of the greatest flexibility even beyond retirement for you. For example, if you need money for a business, real estate, education, for a child, or say you don't want to fully retire early, but rather move to part-time and have that supplement your income even though you're getting paid less. Honestly, in my opinion, this can be one of the best accounts to help you accomplish all those different goals. Okay, so just to share what I've seen over the past 4 years, especially after the pandemic, I've honestly noticed a trend of people sort of rethinking their lives, at least their work lives. And many of the people I talk to have done a great job saving money. Now they want to explore what maybe quitting their job and moving towards something perhaps more enjoyable or more purposeful might look like. Now, the problem is that the way our lovely government structures these accounts, they're naturally going to discourage people from early retirement. And we see that because of those penalties that are imposed, like the ones we talked about earlier. So what are options? Well, we can either give up and keep working a job we hate, or we can do some great planning to help get around this and around some of these hurdles. And of course, my favorite option is doing some great planning with a taxable brokerage account. So who should be thinking about using this account? First, I'd say this account is fantastic if you are already maxing out your retirement accounts. This taxable brokerage account is a great place for you, especially if you have surplus savings and maybe you even have extra cash beyond your emergency fund that you're willing to put to work and put towards the future. If you've already saved as much as the IRS will let you into your tax deferred retirement accounts, this is a great account to explore. Secondly, this is for someone that wants more flexibility and liquidity. The big difference between a taxable brokerage account and retirement accounts is, of course, taxation. Now, here's the trade-off. You're not going to get a tax deduction for the money that you put into a taxable brokerage account as you do with a traditional IRA or your 401k, but you also don't pay taxes when you withdraw, or even a 10% penalty if you withdraw early. Instead, the money in a taxable brokerage account taxed in the year in which it is earned. It's basically taxed all along the way. So just a trade-off that you want to think about if you're deciding between the two. Lastly, this is a great account for those that want more control over their taxes. A huge benefit of a brokerage account is the control they offer both today and in the future in terms of how you pay taxes. Like I said, when you withdraw from a pre-tax retirement account, you're going to have to pay ordinary income taxes, and the government's actually going to force you to take money out of this account later on in your 70s, called required minimum distributions. But with a taxable brokerage account, you only pay capital gains tax rates, and it's even better than a tax-deferred account if you have heirs. When you pass away, the taxable basis is stepped up to your date of death, which means your heirs can liquidate your taxable account and not have to worry about high appreciation. And I've seen this for some clients we work with. They might have a multi-million-dollar taxable account, yet they're paying $0 in taxes, or very, very little in taxes, despite having such a large account balance. For example, let's say you retired next year in 2024. I'm just going to use a very simple illustration so you can see how this works. If your income was purely coming from a brokerage account, as you can see on the screen, and we assume you also take the standard deduction and you hold your investments for more than a year, you can generate over $123,000 of long-term gains and pay, look at this, $0 in taxes, as you can see by this tax report that I'm showing you on the screen. And you can see that you're in the 0% marginal bracket. And if I scroll down here, you're also in the 0% capital gains bracket. Now, of course, there are other things you can do in coordination with this, like Roth conversions, but we'll talk more about that towards the end of the video, because that could also save you thousands, if not hundreds of thousands in taxes if you do it right over your lifetime. Okay, so before I get into 4 excellent strategies that you want to know as you build out your taxable brokerage account, you may be thinking, okay, Matt, I like it, I get it, but aren't there other ways for drawing funds from your retirement accounts before age 59 and a half? You might also be thinking, wait, I thought Roth IRAs are the best option, tax-free growth for my lifetime. And look, I do have a strong appreciation for Roth IRAs, but when it comes to withdrawal strategies, Roths are such a tax advantage account that we generally want to leave these and leave them untouched and invested for decades. And the reason why is because if you look at your entire portfolio, leaving that account alone and essentially investing it properly can mean years of untouched compound growth. And that's why we'll opt for the brokerage account for withdrawals if that's an option for you. And while certainly there are strategies to access retirement funds early, in my personal opinion, they're not quite as optimal. More so a better backup option that you have on the table. Take, for instance, the Rule of 55. This is a provision that allows penalty-free withdrawals if you leave your employer after turning age 55 and you keep your work retirement plan at the sponsor, aka you don't roll it into another account like an IRA. The thing to be aware of is that while withdrawals may be penalty-free, income taxes still apply. And every employer is different. For example, one might permit withdrawals when you want, as long as you meet those first 2 rules, while another might demand a complete liquidation, which could potentially force a large taxable liability for you. Or some won't allow it because of all the paperwork involved. You need to check with your employer to see if they even allow it. And there are other rules and strategies such as Rule 72T, which can at least help you access a little bit of the account, but mostly not quite enough for most people to fully live on. There's also Roth laddering, which can be an option. But honestly, what I've found is that the taxable account stands out as one of the most flexible and simple, straightforward options for early retirement planning. Okay, so let's talk about 4 different strategies to help you use this account effectively, because otherwise this account is not as useful. So firstly, when you hear about investing, you often hear about asset allocation, which is very important. You might hear things like 80-20, 70-30, 50-50. You're listening to the right investment mix. Whatever investment mix your plan calls for, that doesn't mean that every account you own needs to be the same mix. So what do I mean by that? For example, if your financial plan calls for a 70-30, we're just going to use a simple example here. This is not a recommendation. Each account can have a slightly different role. You have to look at the full picture of all your accounts and all your income sources. For example, you might be placing investments that have higher interest or higher dividend payouts in a tax-deferred account like your 401k or your IRA because you don't pay taxes on the money within those accounts. You're only going to be paying taxes when the money comes out. Your Roth IRA, you might be heavily growth focused because you know that account will be the last one you tap into for any sort of income or payments that you need from that account. That way it can continue to compound tax-free for decades. And lastly, for your taxable account, you may choose to hold more tax efficient investments, where there's less turnover, there's less capital gain distributions, and where you can also own, if your plan calls for more conservative investments, there are tax-free bonds such as municipal bonds, so you don't pay tax on the interest. Again, everyone's investment mix is different. But my point is that by strategically placing assets in the right accounts based on their tax characteristics, you can potentially reduce your lifetime tax bill and sometimes even enhance the after-tax returns on your total investment portfolio. And if you zoom out, right, each account might have a different allocation at the account level, but your overall portfolio is right on target. The second important factor when you strategize for this account comes down to when do you need the money. Look, everyone and their mother is gonna have a different mix. There's just not one size fits all cookie cutter solutions when it comes to these problems. Well, actually, I mean, you could probably go online and find a robo-advisor, or maybe ChatGPT can take your age and risk tolerance and spit out an allocation, but we need to go deeper. You might have rental income, a pension, an inheritance, or even part-time income, and all that's going to play in a role in how you invest your brokerage account and when you need the money. For example, if you want to be at a position where you can retire at age 50, you'll likely want to be invested in a way where you can create income for nearly a decade before you can access your retirement accounts penalty-free. Of course, you want to do this very tax efficiently and strategically, and you want to be careful not to just blindly rebalance your entire account and not be aware of the tax consequences. Next, you want to look under the hood at some of your investment options. Again, you have a lot more options outside of 401k, so that's going to require more research. As you may know, this is something my firm specializes in, helping people retire early and coordinating it with all their income sources and entire financial picture. But one of our core investment philosophy is keeping unnecessary investment costs very low. For example, let's look at two funds here. Right here on my screen. This is not an investment recommendation, of course, but these are some well-known funds, and I'm just going to blur the names just because of the point I'm trying to make here. But both of these are essentially index funds that are there to mirror the S&P 500, so US large cap stocks. So you'll notice first on the left is an example where a fund where the underlying expense ratio right here, essentially what you're looking at is the cost of owning this fund is very cheap. Cheap isn't always better. You want to make sure you're getting the value for what you're paying for. But in this case, if your goal was just to get simple exact exposure to large cap US stocks through the S&P 500, this could be a very affordable option. As you can see, the net investment expense right here is 0.03% compared to a lot of the index funds out there. That's pretty good. So on $1 million investment, that's going to be around $300 worth of internal expenses. But let's look at a similar index funds right here to the left with the same exposure to the S&P 500, very, very similar. And you can see below the overall allocation right here is pretty identical, but unfortunately this fund has an expense ratio of 0.52%. That's around $5,200 per year on $1 million investment. And my point here is that unless you're getting additional value on this fund to the right and you're not just mirroring the S&P, you want to make sure you compare your options. And if you just want to mirror the S&P 500, I'd rather not pay an extra $4,900 to accomplish that. And the last way we want to effectively use this account comes down to diversification. So a big point that comes up a lot when it comes to investing for early retirement, a lot of people have done a great job accumulating, but the math starts to change as you start shifting towards retirement. And if we continue on the same theme here of the last point that I talked about, a question that I get a lot is, why don't I just throw everything in the S&P 500? And although the S&P 500 is pretty diverse and it crushed the last decade, people sort of misinterpret this saying you can't beat the S&P 500 with you should just throw all your money in the S&P 500. That saying is more about those that try to stock pick and beat the S&P. That, like many hedge funds and actual mutual funds, and what we know is that very, very few will consistently beat the S&P 500. But what if someone adds additional return streams such as international, small companies which actually have outperformed the S&P 500, value companies that have also outperformed the S&P 500, things like real estate, commodities. My point is that there can be additional diversification that goes beyond large cap US companies. Because if we look at the time period for the first decade of the 2000s, right, from 2000 to 2010, the S&P 500 was down over 9% over that decade. And that's why they call it the lost decade, something you've probably heard online. Which means if you invested purely in the S&P 500, you basically lost money. And for most people that are working, that really mattered a lot less because you're still contributing. You're basically dollar cost averaging. But if you're taking money out, you're basically doing the opposite of that. That story might look a little bit different for your retirement portfolio. For example, adding additional return streams beyond the S&P 500 in the first decade, that period of 2000, that would have helped smoothen out the ride, as you can see by this chart here. Different asset classes perform differently than the S&P 500 during that decade. Again, this isn't saying the S&P 500 is bad. In fact, some of the world's greatest companies are in the S&P 500. It just means you want to be thoughtful in the way you invest your money when you are taking money out. And proper diversification can be a great way to help you achieve that. Now, structuring a brokerage account is one thing. You can actually be in a position in early retirement where you're taking income from this account and paying $0 in taxes, again, because of that preferential tax treatment that we talked about. And then we can convert some of your money, your pre-tax money, to Roth while your rate is at zero or very, very low compared to what it will be in the future. And these timely and properly done Roth conversions can save you thousands, if not hundreds of thousands in taxes over your lifetime, especially if you have the right withdrawal strategy and you're not just relying on the 4% rule for early retirement. But Roth conversions can be dangerous and can be a complete waste of your time if you don't do them right. So you're gonna watch this video right here so you can avoid all the mistakes that comes along with Roth conversions. Again, this is Matt. I'm a certified financial planner and advisor with 1 Degree Advisors. Thanks for watching, and I will catch you guys on the next episode.